We're going to look at GST and its impact on the income statement. So we looked at these examples in the previous lecture, but let's just go through another transaction. A business made a cash sale of $1,000 plus $100 GST. Why is the $100 not considered to be revenue? Well, to answer that question, we've got to look at its effect on the accounting equation. So just looking at the GST component, cash has gone up $100. Liabilities have gone up $100 because we owe the government money, and therefore there's no impact on owner's equity. So looking at the impact on the accounting equation, assets have gone up $100 in the form of the cash we've got. Liabilities have gone up $100 because we owe the GST to the government. And lastly, there's no impact on owner's equity. So looking at the definition of a revenue, this can't be classified as revenue because while there is an inflow of economic benefits in the form of cash, there is an increase in assets in the form of the cash at bank asset. There's no subsequent increase in owner's equity. So therefore, any GST we receive is not revenue. Looking at a similar transaction, although this time it's a credit sale of $1,400 plus GST, why is the $140 charged to customers not considered to be revenue? This time the asset that's going to go up is debtors. However, the impact on liabilities will be the same. That GST we've charged the debtor won't belong to the firm, so it will increase our GST liability to the government. From the accounting equation perspective, my assets and my liabilities go at 140, and owner's equity, there's no impact. So looking at the revenue definition again, is there an inflow of economic benefits? There is. A debtor is going to owe us money. Has there been an increase in assets? There has. Debtors has gone up, but again, it's the last part. Owner's equity does not go up, so therefore this can't be classified as revenue. Let's look at the payment side of GST. Let's assume the business paid $300 for electricity plus $30 GST. Why is the $30 GST not an expense? Again, we've got assets, in this case, decreasing by 30. The other effect here is that our liability to the government for GST goes down $30. So assets down 30, liabilities down 30, and the impact on owner's equity is 0. So looking at the definition of an expense, do we have an outflow of economic benefits? We do. There's cash leaving the business. Has it decreased assets or increased liabilities? It has. Assets have decreased. But the last part of the definition is not true. Owner's equity doesn't decrease. So therefore that $30 is not considered to be an expense. Finally, let's assume we had $900 rent plus GST and it's been put on credit. So in this case, I've got creditors going up $90 and GST liability going down $90. So the impact here is none on assets, none on liabilities by the time you factor in the increase and the decrease of $90, and nothing on owner's equity. So looking at the accounting equation again, is there an outflow of economic benefits? There is. We're going to owe creditors some money. Has it decreased assets or increased liabilities? It has. Creditors have increased. But is there an overall decrease in owner's equity? In this case, there's not. So in summary, the following things should never be in the income statement. Anytime I collect or charge GST from customers, that just shouldn't go under revenue. Similarly, every time I pay GST or get charged it by suppliers, I can't categorize that as an expense.